So when I'm looking at price, I have all of this higher time frame weekly perspective in mind. So if I were asked, which time frame do I spend the most time on? It's the weekly chart. Now, why do I spend the most time on the weekly chart? Number one, as I taught my students one-on-one in the mid-90s, and the way I teach my students in mentorship, and the way I've taught and shared in those mentorship lectures on my YouTube. Don't buy people pirating my stuff and trying to sell it to you. It's been made available to you on this YouTube channel for free. Go and study it at your leisure. Go at your own pace. There's no rush. I'm not taking the videos down in November. They're staying up. That premise of how I go into the marketplace and what I'm looking for on the weekend, usually either on a late Friday evening once my whole family goes to bed and they've turned down for the night. I don't sleep like a normal person. So I do a lot of study really, really late in the night or early in the morning before they wake up. Or if I don't get that, I do it on a Saturday. I look at the weekly chart in reference to a monthly chart, a 3-month chart, a yearly chart, and I'm looking at it the same way I'm doing here, okay? And I'm trying not to steal too much thunder from future lessons, but just know that what I'm doing here, I've done that with a monthly chart. I do it with a 3-month chart. And on TradingView, it's really nice because if you go in, if you type 1M, it takes you into a monthly chart just like that. And right away, you can see things that you may not have noticed before. So you have a 1-month chart here, and right away, my long-term students can see right away, they're thinking, wow, that thing used the volume imbalance right there. The separation between this body's close and this body's open. That monthly candle went right up into it there and then went lower all month. So I'm looking at those types of relationships. And you can look at 3M. It'll give you 3 months of data. You can see how we're drawing down into this buy side imbalance, sell side inefficiency, which is the same thing I just highlighted in purple on the weekly chart. That's this here. It's the same thing. So in my mind, I like to look for those first. And if there is no inefficiency, then I'm looking for liquidity. So in summary, let me rephrase everything I just said. When I sit down on the weekends, whatever time I'm going to be doing my analysis, the market is not trading. All of my analysis is done when the market is not trading. What I'm trying to predict, to anticipate, not react to, what I'm trying to predict and or anticipate is where is the present weekly candle reaching for higher or lower prices. If I see an inefficiency like this right here, that purple shaded area, I'm expecting price to try to draw down into that. If this inefficiency wasn't there, I would look for that low because that's where sell side would reside, or consequent encroachment, which is the midpoint of this candle's tail. So it would be this. Let me make sure I have my cursor sitting here for a second before I start saying anything more. I would either look for that midpoint of that candle's tail, which is consequent encroachment, or I would use the low of that wick there. If, folks, listen, if there was no inefficiency that's shaded in purple, if that wasn't there, I would be expecting price to draw down. Now, why would I expect that? What makes me say that? Because we already hit our targets that I covered in the previous weeks. For those that weren't here, I was talking about how dollar was going to go higher, that we were going to use this shaded area here as an inversion fair value gap, and it would treat it as something bullish to trade up into the weekly order block, which is this opening price of this candle here, this candle's opening price. That's the weekly bearish order block. It was acting as a target. Then I said the mean threshold of that candle, which is the middle point of its body in here. That's the bearish order block mean threshold. That was also a target. So once it hit that, we wanted to see what's going to happen. Once a target's met, whether for the week or a day, you have to get comfortable, grow real comfortable with just simply sitting still and waiting. Move very, very slowly when you're trying to make money. And I learned this lesson from Larry Williams. It didn't make any sense when I first learned it or heard him say it, and it took dozens of times of blowing out accounts, not listening to that advice. Move slow when you're trying to make money. Move fast when you're trying to preserve it or protect it. If you watch something pan out that you have done analysis on and you've been successful with it, don't be in a rush to get another dopamine hit because that feels good. That's a neophyte, that's a brand new trader's trap. You see many times individuals that are open about what they've done wrong, and they use social media like a confessional. Father, I've sinned. Look what I did, and I blew my account. Okay? You don't need to do that. Don't do that. Once you see something pan out, meditate on that. Let there be a period of time between where you've seen something pan out, you were successful, and then really record how that felt for you. Because in the future, you're going to have periods where you do something wrong. And it may be a week long of that, a series of doing things incorrectly. And if you don't journal the times that you've done it right, not just when you've done it wrong, but when you do it right, and you encourage yourself and you remind yourself that you followed the rules, the market panned out like you were hoping it would, and you anticipated that, you're conditioning your subconscious to hold on to that as a positive experience. But when you're journaling, you're not recording your negative results in a manner that is condemning. You don't use language or terms like, oh, I was stupid, or this stuff is never going to work for me. Never. Very, very challenging because you don't know where you're going to go as a trader. And we're going to cover more about where you should go and how to determine that for yourself. But you take all this information from a higher time frame. I do this, and I look at where price is likely to go. It's only going to go up for one of two reasons, okay? Price delivery continuum is the movement from where price is right now to future delivery. So where it's going to be 5 minutes from now, a week from now, 2 days from now, 2 sessions from now. It's going up to take out buy stops, or it's going up to trade into some kind of inefficiency, like a fair value gap. That is it. That's the only two reasons why price goes up, period. It's not buying pressure. Price goes up to seek liquidity. And if it's going up, what liquidity is that? Buy side liquidity, buy stops, okay? If it doesn't run for liquidity on that particular time frame, it's going up for an inefficiency. That means a gap. A gap would be like that purple shaded area here, or this, I don't know what that color would be called. We'll call it a pale orange. That gap between this candle's low, that candle's low over here, and this candle's high. That's what's being shown here in that little pale orange shaded area that's noted as the weekly inversion fair value gap. That gap and this purple one here, they are called inefficiencies. Think about the pain analogy I gave you. When price is moving back and forth in a defined range, what's the defined range here? Where your eye looks at price, just like I have it shaded here in pink, price has moved. When price is moving back and forth in a defined range, what's the defined range here? Where your eye looks at price, just like I have it shaded here in pink, price has moved rather efficiently inside that pink area, up and down. Okay? When price entered the low end of this pink shaded area, now we don't know that pink shaded area is the range yet. What I'm saying is when I'm looking at price, I'm looking at how price was delivered during a period of time in whatever time frame I'm looking at. So this is applicable to whatever time frame you're looking at, whether it be a weekly chart, a daily chart, 4-hour chart, 6-hour chart. 15-minute chart, second chart, it doesn't matter. Okay, it does not matter. What matters is where are the inefficiencies and where are the stops. Above old highs is buy side or buy stops. Below old lows is sell stops or sell side liquidity. Those are the two things I'm looking for after my eye goes through the chart and I'm looking for the inefficiencies. So the first thing I'm looking for is inefficiencies. That's the first thing I'm looking for because that's the array that the algorithm reaches for first. It pans for any inefficiency. If there's no inefficiency and we're in a premium and we're likely to go lower, then it's going to be looking for sell side. Reverse that. If we are in a range and we're in a discount and there is no inefficiency above price, but there's a short-term high, it's going to run for the buy side. That's what I'm doing on the weekly chart. So for the folks that are hammering themselves and beating themselves up, please teach bias. I just did. But what you're wrestling with is you don't have time looking at charts like I'm showing you here. You see this pink shaded area? How the market entered it, went up to this candle's high. The next week we opened up here. Then we traded higher up to this point here. Then the next candle or next week we open, we trade down and overlap all the way and into the previous high. So there is no fair value gap formation whatsoever in the candle I'm highlighting right now. Notice that? The candle to the left of it's high and the candle to the right of it's low. There is no separation like you see in that purple shaded range. That's a fair value gap. There is no fair value gap between the candle I'm highlighting here with my cursor using the candle to the left and the candle to the right. So what is actually happening there? The price is going up and down, up and down. That's like that wall being painted very efficiently. Is there any inefficiency there? No. So at that time, when we start on this week, we open, we rally up, make the high, and then we close after making a low here. So there's been a lot of delivery up and down in between the range high of this week and the close of this candle here. Now, why am I picking that close? It's because I'm showing you how prices reacted in here and why I was telling you on the 13th in a live stream that can't be cherry picked. It was told to everybody watching it that I want to see dollar reach lower. Okay, and we haven't even got off the weekly chart yet. I'm teaching what I'm looking at, and this is why I'm trying to tell you, I spend the majority of my time on the weekly chart. I'm looking at how price delivered. Think about what I'm showing you here and how that relates to this area right over here. Think about that right in here. That same idea, we can apply it to over here. I promise you, I'm taking you somewhere. Even though if you think you don't know what your understanding and confusion is probably peaking right now, just keep staying with it. I promise it'll make sense as I'm going. Same thing here. Price opens up, trades higher, back and forth delivery, all the way up to the high, back and forth, and then we leave it. So before this broke down, is there any inefficiency over here? Below this pink shade there, is there any inefficiency? Inefficiency would be like this candle here. How it has that separation between the candle's high to the left of it and the candle's low to the right of it. Does that occur or form anywhere underneath this pink shaded area in all of this? Do you see that? Yes. Right here. I'm just going to use a short little trend line. I promise you folks, this is the stuff you're looking for. Even though you may not feel like it's important right now or it doesn't make any sense, I'm going to take you light years ahead. Most of everybody else out there today. So there's a gap there. So I would take like this rectangle here. I would highlight this, but I'm only showing it as a small little section with the rectangle not being here, but just simply using the trend line sections. So we have an inefficiency here. So when the market leaves this range, It's in a premium relative to the low and where it traded to. It's in this range consolidating, and then it leaves it. Where's it going to go? Well, there's several things. You can use the consequent encroachment of this wick, midpoint of that. Then you have the gap here that this traded down into, but left the majority of the gap still untouched, right? So when it drops here, price is going to want to trade into this area here. Does it do so? Yes. And again, that would be bias. That would be bias for that particular week for the dollar. What do you think that that would mean for you Forex traders that want to trade pound dollar? What would you anticipate that week? This week I'm highlighting right here. How would you use that information? You would go into your charts and back test any long positions during the London Open between 2 o'clock and 5 o'clock in the morning, New York local time. You would look at your AM session kill zone, the New York kill zone, between 7 o'clock in the morning and 9 o'clock New York local time. You would look for the model of 2292. You would look for optimal trade entries. You could look for silver bullets because silver bullets form in the kill zones between 7 o'clock and 9 o'clock. Ooh, what'd I say? Yep, we're teaching that again today too. It's not limited to just index futures and 10 o'clock to 11 or 2 o'clock to 3 o'clock in the afternoon for index futures. If you're a Forex trader, everything that I teach is applicable. Even though you see me predominantly teaching it in E-mini S&P and futures contracts, it's applicable to Forex. There's subtle little rules that you have to worry about, and time is the factor that's got to be considered. Because yes, there are silver bullets between 10 o'clock and 11 o'clock in Forex, yes, but they are really good ones between the 7 o'clock and 9 o'clock New York Open kill zone, and between 3 o'clock and 5 o'clock London Open kill zone. They're there every day. Every single day, you have a reason for you to find a setup. Now, again, that is not an invitation for you to go in and try to trade every single day, okay? So I want you to think about how the market moves in these ranges. This is a balanced price range. Why is that a balanced price range? Because the market has moved up and down within it, and then it left the range. So if it's going to leave the range, what is the algorithm? Let's make an argument for the sake of folks that don't want to believe there's an algorithm that controls price and there's no amount of buying and selling pressure that's going to change that. Market's going to go where the market's going to go. It's predetermined. Your daily high and low is predetermined. Whether you like it or not, it is what it is, okay? How can we determine where that likely higher low is going to form, or where would it likely reach to? Starting on these higher time frame weekly charts. And if we know that we can see prices likely to want to expand lower, think about it, because we're on what chart, what time frame up here? Weekly. So my analysis, everything that I'm doing on the weekend, when the markets are not trading, I'm trying to determine what's the strongest directional bias that can be derived by looking at the weekly chart. What is it likely to be reaching for on a weekly candlestick chart? It's going to either be reaching up for buy stops, or it's going to be reaching up for a fair value gap above where the market is right now. If it's likely to go lower, then I believe it's going down to a fair value gap below current market price, or it's going to go down to reach for sell side liquidity below some old low. That is not complicated, folks. These things on your chart, they're not hiding from you. They've been in plain sight. You just never been told to look at it this way because you're trying to apply indicators and all these things. And frankly, when you look at it like this, you should be able to see it really quick. See, when I'm looking at the chart like this, my eye jumps real quick to inefficiencies. My eye jumps to that. My eye jumped to that. That. I'm probably moving faster than the live stream can keep up. And then obviously the gap that I just showed. And every high, every weekly candlestick, high and low, is a factor as well. They're going to be used again. They don't just get used one time and they expire.